and just wanted to show you a few things. I celebrated a milestone birthday this week, and I told my wife the other night, I said, it's the first birthday I've ever had that I had like several days of birthdays. It was like, it wasn't just on my birthday, but it was like 2 or 3 days of celebration. And I kind of like that. It is really awesome. So if you've never done that, if you've only celebrated on your birthday, kind of spread it out a little bit. Do your birthday, maybe, the day after. You could even skip a day. I highly recommend that. So one of the gifts that I got, and I'll show you this. It says, "You can't tell me what to do. You're not my granddaughter." So, we got that going for us. And also, this I thought was kind of cute. "Home is where my honey be." So anyway, I thought that was interesting. And then I got this to hang out in my honey room as well, keeper of the bees. So we got a lot of stuff bee related. I don't know why that is. I don't know. Maybe somebody can enlighten me on that. So, just a little update on the bees. I went through 3 of my hives yesterday, and one of those does not appear to have a queen. So I've got to do some more work on that hive. They have tons of food. They have a lot of bees in there, but I see no brood, no eggs, no larvae. So it's a bit of a challenge. So I'm going to have to figure out what to do with that hive. So my next step is to actually go through that hive and actually search for a queen and see if there's one in there. Maybe she's just not laying for some reason, but I also did not see any queen cells. So I don't know. It's going to be a challenge. So, but anyway, I got that hive to deal with. Then I got 3 more hives down south of here, and I'll check those out probably tomorrow. And then kind of getting ready for winter. It's about getting them enough food for the winter. 2 of the hives, I think, here are in good shape. One of them I'm going to have to feed a little bit. Drinking iced tea in the red Solo cup tonight. Just thought I'd mix it up a little bit. So anyway, I thought I would just update you on the bees. And then here's some fun stuff we can chat about. Let me do this. You guys ready for this? This is the update on the AI portfolios. If you've not been on the program before, and somewhere around the, I don't remember, 11th of August, maybe, I went to ChatGPT and I went to Gemini, and I said, give me a portfolio, dividend investing portfolio, so that it produced, a portfolio of stocks for me. So I have my portfolio, I have the AI Gemini portfolio, the AI ChatGPT portfolio, and then I also compare that against the NASDAQ, the S&P 500, and the Dow. So we're going to take a look at that before we kind of get started here. Last place is ChatGPT. This ChatGPT portfolio has been in last place 3 of the 5 weeks. So it's been a bit of a poor performer, at least over a 5-week time span. And that's basically how long it's been. It's 5 weeks. So if anybody wants to give me their guess on number 1, you could do that in the comments. Hopefully you can do that before I actually get there. So we know number 1 is not ChatGPT. So you got 5 to choose from. You got the NASDAQ, S&P, Dow, Gemini, or Wealth Circuit. Which one do you think is number 1? Let's go that route. And it is one that has not been number 1 up to this point. All right, number 5. Oh, they just gave away. It's not the Gemini portfolio either. So we are looking at Gemini at a 1.1% return over that 5-week period, which, is not really that bad. I mean, that's, if it's 5 weeks, let's say there's 52 weeks a year, or let's say 50 weeks in a year, that gives us 10% of the year. That means that if we did that 10 times, it'd be an 11% return, which, is not a terrible thing. Then number 4. So we did 6, we did 5, we did 4 is the S&P, and it is 3.79%. So that's actually really good. So let's multiply that by 10, and that'd be a 37.9% return on an annualized basis. It's going to be close. It's not exact, but it's close, just for fun, grins and giggles, as they say. Number 3 is the Dow. Now, this is week 5 of this portfolio, of this comparison of portfolios. The Dow Jones Industrial Average led the first 4 weeks. So the Dow has taken a bit of a beating this past week. It dropped from number 1 to number 3 in this portfolio. So that's nothing lasts forever, right? All right, so that leaves us with number 1 and number 2, and I see no guesses. So you guys probably don't care, but that's okay. I do, because I think it's kind of fun. All right, the number 2, we're down to NASDAQ, or the Wealth Circuit Investing Portfolio. And number 2 is NASDAQ. NASDAQ is at 4.5% return over that period of time. Now, this does not include dividends. It's only the capital gain returns. I just don't want to do the work to try and figure out what the total return is, because it's really more for fun than anything else. And then obviously number 1 would be the Wealth Circuit Investing Portfolio. It's the first week that we have actually been in first place. Now, each week that I do this is on a cumulative basis. So this is a 5.42% return over the last 5 weeks. So I'll take that. That's a pretty decent return. So there you go. We got that going for us. Here's just an update on the portfolio. You can see all these squiggly lines, the green squiggly line. Let me see if I can make it bigger. There we go. That green squiggly line there is the Wealth Circuit Investing Portfolio. Now, I will say this. Let me shrink it back down a little bit. The the NASDAQ on a year-to-date basis has now passed the portfolio. So it is this is as of Friday, this past Friday. So it is ahead of us by 0.36%. But you know what? For a retiree's portfolio to be performing this well against all of the indices, I'm just tickled pink. Is that the right way to say that? Tickled pink about that. So let's see who all's here. I think that's it. Let me just make sure. Yep, that's it. The next one is blank. So there we go. Now we get on to some fun stuff. Let's talk. Let's see who else here. So we got Michael. Michael is awesome. And his 12-year-old instructed him to sell Pepsi and buy Alphabet. And he's glad he listened. Yeah, sometimes there's wisdom in the mouths of babes, right? So that's good. I'm glad you listened too, Michael. That was good. We got Rust Moments. Hey man, I missed you tonight. I had a great time with you last week on the broadcast. So I'm glad you were here last week, and I'm glad you're here this week too. So back in December, it's up 62%. I don't think Pepsi's up 62%, so I think that was a pretty good move, man. Hey, Gendry's here. I haven't seen you lately, Gendry. It's good to see you as well. Yeah, this shirt was obviously given to me by my granddaughters, so they can pretty much tell me anything, and I'll listen. So they're fun. I enjoy them. So I'm getting famous. I'm not really sure about that, but I couldn't find you. So I had to put in Kevin Burgess Wealth Circuit Investing, and I found you. That's great, man. I appreciate that. It's funny how those algorithms work. I mean, I think it's really just that I've been around for a while. It doesn't really mean that I'm famous, but it's cool, man. It's cool that you can look me up and find me. That's probably the only place in the world that would happen. I saw Winnie the Pooh stalk G. Oh, stalk. Winnie the Pooh stalk. I'm not sure. You're gonna have to help me. Oh, stalking my house. Oh, I gotcha. Yeah, definitely. There are beekeepers who deal with bears, and bears is it's a different way to handle protecting your bees. They actually, so wherever you live that has bears, you will put an electric fence around your beehives to deter those pesky black bears. So yeah, that's it's not fun when you're a beekeeper if you see a bear stalking your house. That is not a good time. UNH or ELV, yeah, we can chat about those tonight. I own both of those. Um, I got this new little folio for my birthday as well. I can write things down on it rather than usually I have like an envelope from the mail or whatever just laying here on the desk, and I'll write it on there. So this is much more professional. So let's be professional tonight. ELV and UNH for Gendery. We will get to that here in a little bit. Let's see. Stream sometimes post for me. Oh, I think that's part of that other conversation. Well, Fast Eddie is in the house. Good to see you, my friend. So let's get to talking about, it looks like I'm caught up in the chat. So let's get talking about Google. We'll talk about Google first, or Alphabet, I guess I should call them. And I thought it would be helpful. Actually, I don't know what I thought, but let me get over here to this right here. Find a good way to kind of get into Google. Here we go. All portfolios, Google, and there. So let me pull you guys into the conversation here. All right, so here's Alphabet Class A is Google. That's the one that I own. I think the only difference is voting rights. There is a GOOG as well. But today, Google went up by 4.49%. For the and this is what Michael was saying a little bit ago. I mean, if you look at the 1 year to date's 33%, the 1 year's 59%. It has just been moving up, and that's kind of the way we like it. I did sell off some of my Google. It had gotten almost 7% of the portfolio. I didn't buy 7% worth, so I decided to go ahead and knock it back down to about 4. I think it's 4.25% now. Let's go look. Let me see here. Current portfolio, Alphabet is 4.7%. So now it's 4.7% of the portfolio. And I think that's pretty good. I do think that there's more room to run, but I just didn't want to be that overweight in Alphabet. I've got a couple of other stocks that are that high. One of them is Microsoft, and I'm not really planning on backing that down at this point. And the other one is Amphenol. I started buying Amphenol earlier this year, and it is now 6.5% of the portfolio. It has just grown like a weed. So anyway, I'm not sure why I was going there, but I did pull Alphabet back in the portfolio. So let's take a look then at let's see where they are on fast graphs. I think that might be kind of interesting. Looks like the internet's running a little slow. There we go. There we go. All right, let's pull up GOOGL. Well, it is running slow. All right, so you can see this major rise in price here. Let's knock this down to about a 10-year time frame. It's getting a bit pricey, right? And so, the earnings, I guess, as you move forward, it might just be a little bit pricey to get into Google at this point. Let's see where I have it in the in here. Let me see here. I don't have it as a buy. I think it's now down around like 100 and where is it at? I thought I could just find it. Well, oh, there it is. 112. So that means it's the number 111th stock that I track. That means that there are 110 stocks that I think are better deals than Alphabet. And you can see here it's about a 4.74% of the portfolio. And yeah, so I think Google is a great investment. I still think there's a lot of room for it to run. We had, I don't know really of any major news today that drove it 4.5%. I think my friend Daryl said that it was probably some of the, what do you call them? The institutional investors who did not get in on the rise and wanted to, and so that caused the price to go up. That's probably more, speculative, maybe. I'm not really sure. There was some news today. Let's see if we can find that news. There was some news today that Google offers to sell parts of its ad tech business, but DOJ wants more. So I don't see why this would drive the stock, though, to be honest with you, why it would drive it up 5%. It just doesn't seem to be that big of a news cycle to me. It just means that there's still a pretty good ways away between the DOJ and Google. I don't know why that would cause a 4.5% rise in the stock. So, but I do think Google is it's got a solid business model. I think it's got their whole Gemini thing. I think Gemini is better than ChatGPT and Perplexity. So I think they've got a lead in that. So I'm pretty good with having Google in the portfolio. I just wanted to peel it back just a little bit. Let's see what Morningstar values them at. I could have looked at my spreadsheet too, but that would have been too easy. They have them at a fair value of 237. Now this price here is 240. That was yesterday's close or Friday's close. Today's close is 251. So I think Google is it's solid. I'm not planning on selling anymore Google. I have it where I want it in the portfolio. Here's I wanted to talk also about Target. And I know there was a question in the Discord. And by the way, if you're not a member of the Discord, feel free to join us. There's a link in the notes to this live stream. Feel free to join us. It is free to join, and if you got questions about stocks or anything like that, let me know. As a matter of fact, this question came from the Discord, and it is my friend Gnome, who is probably asleep at this moment. He is overseas, about, I don't know, 7 hours difference, maybe 6, 7, or 8, something like that. So he always catches us on the rebroadcast. So I thought I would answer, at least from my perspective, about Target. And I think his question really was, is now a good time to buy Target? It is depressed in price, and they changed CEOs recently. Is now a good time to invest in Target? So I thought, first of all, let's look at some numbers. So Target, they've got a dividend safety rating of 80 according to Simply Safe Dividends. They have a yield of 5.15%. They only grew their dividend this past year, or in 2025, by 1.8%. And maybe I'll talk about theoretically what that means for me as an investor. But they do have an A credit rating, so that's nice. $40 billion market cap. They have let's see. Now, they over the last 5 years, they've averaged 11.3% in growing the dividend. And over the last 10 years, it's been 8.9. Most recently, 1.8%. That kind of, let me talk about that right now. As a company, as a board of directors, as a management team, senior management team of a large public company like this, when you are deciding what you want to do with your dividend, there is a whole stream of work that goes along with that. You have to lay out the planning team of the company has to lay out for management and the board where they believe their sales are going to go, so they've got their business model set up, and it can be 3 years out, 5 years out, whatever the company happens to use as a planning horizon. They can take those numbers and say, okay, what does it look like for us over that period of time? So many times when a company raises its dividend, it's looking at its longer term forecast. And it's saying, if they want to continue to send a message to the investors that the stocks, that the company is still growing, then they can continue to grow the dividend even if they have a bad year or two, right? However, what we're seeing here from Target is that the message they are sending us is that their dividend is only growing by 1.8%, which tells me they don't have a tremendous amount of confidence in the growth trajectory of the company. So now let's take a look at some numbers and see if that kind of bears its way out. Let's take a look at the earnings payout ratio. It's around 59 to 60% as it is right now. So that's not really encouraging for me if I were to want to invest in Target. Earnings per share is dropping. So it went in 2022. Maybe that was related to COVID. I'm not really sure. But I remember at that time, the growth they were just screaming, man. They were just really growing, and everybody was diving on to Target. Target was the next, big. It was the next Amphenol. So, they went from $13.6 per share in earnings. In 2023, they dropped to 6.02. That's more than half. Then they recovered a bit, $8.94. And then in 2025, they even decreased from the $8.94 down to $8.86. Now we're looking at about $7.66 over the next 12 months. So basically what the company is telling us is they don't see a lot of growth coming in the next few years because they're not willing to put their dividend growth into action at this point. Now there's, I'm making a lot of assumptions there, but that's the way I look at it as an investor. Let's see if there's anything else. They have been doing some buybacks, but of recent, not too many. Look at their sales. Their sales are, while it went from 106 billion in 2022 to 109 billion, then it dropped to 107, and then in 2025, 107. In the last 12 months, it's now 106. So the sales are flat at best over the last 4 to 5 years. Their return on invested capital is around 12%, so that's not terrible. If you think their cost of capital, which would include both equity and debt, that cost of capital might be in the, let's say, 8% range. So they are still making a return on invested capital that is higher than their cost of capital, but we'll just have to see if that holds up. Operating margins are 5%, which is kind of lower than it's been in the last, what would that be, almost 10 years. There was 1 year in 2023 that was lower, but man, that their margins are not that great. Their net debt to capital is not terrible. It's 51%. So they basically have half debt and half equity. And so when we think about their cost of capital, there's a cost to owning debt and there's a cost to owning equity. And so, or not owning, but a cost to providing or resourcing your capital needs through those. So interest coverage ratio, it looks pretty good at 13 over the last 12 months, 14 in 2025. So that's, I think their financials are okay. They're not stellar, but to me, the thing that gives me pause about Target is what they're willing to grow their dividend by, which has now been, back in June, 1.8%. So not terribly excited about that, to be honest. Let's go up here and let's see what their fair value is according to Morningstar. The current price is around, it says about $90. Let's see what it is today. They haven't updated Morningstar's numbers yet. So it's about $88.50. So let's take a look. It's $88.50. Morningstar's saying they have a fair value of $123. So let me say this about a stock. Unless a company has filed for bankruptcy, typically that company is worth something. Sometimes a company could be, really having a hard time, but the market is discounting it so much that all of that hard time is baked into the price. And so now might be a good time to buy. And now I'm not talking about Target. I'm talking about this theoretical company, hypothetical company, that sometimes it's a good time to buy, even though the company's struggling because the market is punishing it so much. So hopefully that makes sense. And right now, Target is trading at a 27% discount. Is there anything else we want to see on that? Let's see where the analysts are putting it. They're saying that the target is 104 over the next year, so about an 18% return. So now let's go to more of the what do you call this? The subjective. These are objective numbers here. Let's talk about the subjective part of this, and that is about strategy, management team, and I don't follow Target, so I'm giving you my impressions, not based on in-depth research, but based on what I have seen. And I'm not a huge fan of the management team at Target. Here's one reason why. You guys will recall all of the issues with the LGBTQ, whatever those are. My challenge with that management team is that they purposefully decided to limit their audience, to limit their customers, to limit their target market by focusing on political things. No different than Disney. I don't own Disney for that very same reason. Disney focused on politics, and the way this country is, half the people are on one side of issues, half the people on the other side of issues. But if I'm buying a product, I don't really want to think about politics. I want to think about the product and what it means to me, and how it can change what I do. Um, I'll tell you one of my cool birthday presents here in a minute as well. So anyway, that's I am not a fan of Target, just because they're struggling. They're struggling from a sales perspective. They don't have any growth. Their earnings are not growing, and but there is some value there. They're undervalued by 27%. So you might say, hey, I'm willing to take a chance on that. But just know that you're buying it as a value play because you think it's undervalued, not because you love the growth that you're seeing. So now, if for some reason you think that Target is going to miraculously change its approach, its strategy, the way it hits its target markets, then it might be a good time. But I just don't see that. I've not seen it for the last several years, so I am not a huge fan of Target. So those are my two stocks. I think we had a couple of others. Let's take a look at those. One of them was Elements, ELV. So Elements, about a 16. Oh, wait. I don't know what happened. Almost an 18% upside. It was down 1.5% today. I do own Elements, and it is, let me pull up my portfolio here. Current portfolio. Elements is right here. It is 1.8% of the portfolio. And right now we're down about 21% capital gain wise for Elements. It's not too fun. And then the other one that we're going to talk about, I'll just go ahead and do this while I'm here, is United Health. Now, interestingly enough, we've been down about 15 to 20% on Elements for quite a while. We were down over 30% on United Health, and now it's about 15.5% down. So things are looking up for United Health. I think the future is bright for both of these companies. I wished I had waited to buy them until now so that I could get them cheaper, but I still think that they are worthwhile investments. I'm not willing to sell them at this point. So I like both Elements and United Health. I don't have a buy rating though on I do have a buy rating on Elements, but not on United Health. United Health, I think I have a hold on. There it is, United Health Group. Yeah, I have it as a hold. And, I see it as a nice return, 11% over the next year, but I think there are better stocks out there. Elements, I see a 23% return over the next year. Analysts are saying 20%. So, we're in the same ball game. Doesn't mean either of us are going to be right. It just means that it helps me when I'm investing to try and go after the stocks that have the most potential for adding to the portfolio over the next year. Is there anything interesting? I don't think that there's anything new in either of those. So let's see if there's any news here for Elements. We'll look at the overview. See if there's any news. So United Health price targets raised to $395. That's awesome. Love that at Morgan Stanley. The management team is going to meet with Oppenheimer. That was 6 days ago. So, yeah, there's nothing new here for United Health or for Elements. Let's take a look at United Health and see if there's anything new there. And why did it switch back? This was 2 hours ago. Gets a price target boost from Morgan Stanley ahead of Q3 earnings. I think we just saw that. So that's good. That's a good sign. I don't see anything else. Courting White House officials amidst ongoing probes. So yeah, I'm not really sure what that's all about, but that's pretty typical, I think. Here we go. 24 hours ago, United Health begins hiring Trump allies to fix problems. Wall Street Journal says so. We'll have to see. Some of this may be true, some of this may not be true, but it's reporting, right? They're trying to report what they can, so we will see. But I like both United Health and Elevance. I think Elevance probably is the better deal right now, the better buy right now. But there's a lot of market sentiment around United Health as well. So I do own both of them. Just real quick, I have United Health is 4% of the portfolio. So United Health is 4%. Elevance is 1.8%. So I've got about 5.8% of the portfolio tied up in both of these stocks. So, but I think I'm comfortable with them. I think they're going to do well in the long term. So let's see what else we got going on here, folks. So Fast Eddie sold Nike, Rollins, and Realty Income. And he bought UNH, Zoetis, and Google. What are my thoughts on that? Yeah, I'm a fan of getting rid of any apparel. I mean, sometimes they do well, sometimes they don't. It's just really, it's kind of cyclical for me. Nike, I'm just not a fan of apparel at all. So I don't have any apparel companies. Rollins, I think that's Rollins, ROL. I think that's that pest control company. I know that they've done well, and so now might be a good time to unload those. I used to own Realty Income and got out of it quite a while ago, maybe a year or even year and a half ago, just because they had grown so much that any growth for them moving forward, the deals had to be so big that it would actually drive the needle for them. And so, if you own Realty Income, they're a fine company to own. They're not going anywhere. But if you're looking for growth, I don't know that you're going to find it in Realty Income. It will grow, and it'll grow every year, but it'll grow at a slow pace. It's got a decent dividend yield. So if you're into dividend yield, then it works. But now United Health, and on the buy side, Fast Eddie, United Health, I think is a decent buy right now. I think that works. Zoetis, isn't that pet insurance thing? Let me just look really quick and see what Zoetis does. That's ZTS. Maybe I got the wrong one. Oh yeah, ZTS. There we go. Zoetis, 29% potential upside. Went down 1.3% today. Let's see what they do. Overview. They got to have something here that tells me. I know where I can find it, though. The handy dandy Simply Safe Dividends. Founded in 19, sells animal health medicines, vaccines, diagnostic products. So I was thinking it was insurance, but evidently it's not. It's really more about medicines and vaccines and diagnostic products for animals. So it could be farm animals, it could be your pets. So I think that has some potential because people love their animals, and rightly so. I think that's fine. Let's see what it's done over the last 3 years. Down 3% over the last 3 years. Over the last 5 years, it's down 8%. It seems to be just kind of hovering I don't know if it's not taken off by now. What is going to cause it to take off? Be a question I would want to ask. I don't own Zoetis, and I don't even have it in my model. So Google, obviously, just talked about them. I think they have grown so much recently that it's not a buy for me at these prices. But eventually, it'll pay for itself, I think. So if you're buying now, it is what it is, right? If you need to pick them up. Hey, Janice is here. Good to see you, Janice. Haven't seen you in probably, a week? Hope all's well with you, man. Let's see. Quarter end window dressing by fund managers might explain Google rise. Yeah, that's what Daryl was saying as well. I think you say it right. It might explain it. I'm not really sure if it does or not, but it's just odd that it would go up so much. I mean, I can see it going 1%, 2%, but almost 5%. That's a pretty big move. Now they're about $3 trillion in market cap. That's fantastic. Yeah, Charles, it's good to see you, first of all. But yeah, you're right. Target is looking like Sears. For the younger crowd who may not know who Sears is, Sears was a, I guess, they had the original Craftsman tool line. They were basically they had the Sears catalog. And back in the day when there were a lot of outhouses, sorry about this, when they had a lot of outhouses, the Sears catalog would come out, and people would use the pages of the Sears catalog after they, had gone through and bought whatever they wanted. They would then use that for their toilet paper. So, hey, sorry. It's a fact. It's a fact. But yeah, so Sears, actually Sears also originally started the Discover company, if my memory's right. And in my MBA program, I actually had a class or two. I don't remember the professor's name, but he used to be the HR guy, HR vice president for Sears. And anyway, so he got out, I guess, at the right time. So yeah, they are definitely looking like Sears, and I don't know what's going to turn that around either, Charles. They've got to have something. They've got to have some hook that causes people to want to go back to Target when they've got Walmart, and Walmart is continuing to win. So we'll just have to see. Hey Pat, what's going on? You checked earlier and didn't see that I was going to be on tonight. Yeah, to kind of just give you a little TMI. A little earlier, I was not feeling well, and I took a little nap, and I started feeling better. So I was like, you know what? I'm going to go ahead and get on, do the stream. So yeah, so I didn't set it up until late. That's my fault, but I really didn't want to set it up and then cancel it. So. But it turns out that it worked out to where I was feeling better. So I was like, you know what, let's do it rather than reschedule. And I did it a little bit earlier, which I thought would be okay. But then my granddaughters came up, and so it caused me to be a couple minutes late. But I think you guys are okay with that. Yeah, I hear you. And I'm doing it a little early as well, Pat. So. Yeah, sorry about that. Yeah, pet pharmacy, drugs for pets and livestock. Yeah, Die Hard batteries. That's right, Michael. That was part of the Sears line, was the Die Hard battery. I still remember commercials where there would be, they would go up to Alaska or whatever. This was before AI, so I actually had to physically film these vehicles in the snow, but they would leave them there for weeks and put different batteries in them, and the Die Hard always cranked up. That was Sears. Yeah, I had forgotten about the road handler tires. Oh, Tough Skins. I had forgotten about Tough Skins, man. My cousin used to wear those Tough Skin jeans. They were you couldn't hurt those things. And anyway. Oh, Dean Witter, that was a brokerage, right? And Allstate. Yeah, that's right. Man, you have a great memory, Michael. That's incredible. I didn't remember all that stuff. I just remembered Craftsman and then Die Hard, when I saw that. But man, you are all over it. So yeah, so anything else you guys want to chat about tonight before I vamoose? Let's see. Oh, there is one other thing I wanted to mention. I'm glad you mentioned it because I had forgotten about it. You guys ready for this? Let's go to the latest. The latest is that, oh, you can't even see it. Boom. Microsoft has raised its dividend by 9.6%, reaching the 16th consecutive year of payout growth. And remember earlier when we said this is really an indicator of what the management team and board of directors are seeing in the foreseeable future. They are confident that they can raise the dividend by almost 10%. I like that. I like to see that. As a matter of fact, if I look at Microsoft, which is right here in the portfolio, 6.5% of the portfolio is Microsoft. I'm not changing that. I'm going to leave them as is. So I'm pretty excited about that. So yeah, 9.6% growth that just came out. I think just came out. I saw it hit the wire right as we were getting on the air. So I wanted to pass that along. One other thing, there is a refresh from Simply Safe Dividends on the outlook for Johnson & Johnson. I'll kind of scroll through this. You can read this. You can stop the video, watch it on replay, whatever you want to do. But they've got all of this background data, and I don't want to bore you with that. But what I do want to bore you with is is the last paragraph, and it says this: overall, Johnson & Johnson's scale, product breadth, recession-resistant cash flow, pristine AAA credit rating, track record of innovation, and geographic diversification seem likely to keep the firm relevant for decades to come. I don't know how you can get a better write-up than that. So I mean, I do have some Johnson & Johnson. You can see it right here. It's 2.5% of the portfolio. That is right at my normal weighting of a stock in the portfolio, 2.5%. So any stock that is above, let's say 3%, I consider it to be overweight in the portfolio. So Johnson & Johnson, it is just a steady Eddie growth company, and I'm going to keep it at 2.5% of the portfolio. You can see it's up 22% in the portfolio overall, so I'm okay with that. It's right at its 52-week high, so that's good. There we go. I lost my mind there for a second. Yeah, I agree, Michael. It's amazing how Sears could destroy such a great franchise. That's a good point. All right, guys. Well, we are at 49 minutes, and unless there's something else you guys want to chat about, I may go drink some more of this tea and rest up a little bit more because I need to do some work around the farm tomorrow. Didn't do much today. We've got muscadines coming out our ears, and need to get those picked. I need to get through those 3 beehives, and I need to find out if there's a queen in that other one. So other than that, nothing. It's fun though. It keeps me busy. Yeah, I appreciate that, Michael. I already do feel better. It's just, I don't know. It's just, I guess maybe all the festivities this weekend with the birthday and all, maybe I just am getting too old for that. Not really sure. Oh, I did update my dashboard. You guys want to see that? Here you go. I'll show it to you anyway. That looks awfully small on the screen. I can see it pretty well on mine, but here, I will move this around a little bit. So this didn't really change. Oh, and then it makes it all kind of weird there. So you can see here the portfolio value, how much is in cash, the percentage of the portfolio that's in cash, what the day turned out to be. I was up 0.4%, which was around $7,000. The S&P was 0.47, the Dow was 0.11, and NASDAQ was up 0.94. Then, it shows me the best performers and the worst performance of the day. That'd be the top 5. Now, this is what I added since the last time I've shown it to you. And these charts are the same, but these charts show the investment by category. So whether I consider it to be an income-related investment, an S&P 500 is the ETF that I have. If I consider it a value investment, meaning that I think the value of the company is actually higher than what the market has it valued at, and if it's a more of a growth-related company, that's 41.5% of the portfolio. So I'm definitely not really even leaning toward growth. I'm kind of falling over into the growth category. Then I have investments by moat. I don't consider ETFs to have a moat. They're just basically a collection of a bunch of different stocks. But the individual stocks that I have 24% of the portfolio in narrow moat, 38.9% in wide moat, and none in no moat. So investments by sector, you can see here, communications, consumer defensive. So shows you a bit of the diversification of the portfolio. Let's see. Let me take Michael off the screen here, and so you can see that. I have added what the portfolio yield is, 1.7%. The yield on cost, 2.28, and then the annual dividend income is about $30,000 a year. Then I also added what was the portfolio at the beginning of the year, what are the dividends and interest that I have received so far, what the year-to-date capital gains are. And so if I add those two things together, it's $232,000 in gains, either through dividends and interest or through capital gains so far this year. So I'm pretty happy about that. I took out $30,000 out of the portfolio, and the portfolio value is sitting at around $1.75 million. That is the first time it's closed above $1.75 million. So I can now say the portfolio is $1.75 million. That's kind of fun. And I think that's it. The rest of this has been there before, but this model keeps getting better and better and better. I'm really enjoying this model. So, dun, dun, dun. There we go. Okay, guys. Well, with that, we're now at 53 minutes. I'm going to get off of here and probably go watch a little television, drink some tea, maybe grab something to eat. I haven't even eaten tonight yet, which is a big deal for me. But anyhow, I hope you guys have a great week. If anything comes up exciting, let's talk about it in the Discord, and I will see you on the next one. Hope you guys have a great one. Bye-bye.